So this is part 2 of the Chapter 7 lecture. We're going to start by talking briefly about, well, I guess maybe not so briefly, but at any rate, talking about notes receivable. So notes receivable are formal credit arrangements between a creditor who's the lender and a debtor who's the borrower. These notes arise from loans to other entities, including affiliated companies, loans to stockholders and employees, from the extension of the credit period to trade customers, and occasionally they come from selling merchandise, maybe some other types of assets, or even sometimes through services. Notes receivable are classified as either current or non-current, depending on the expected collection date. When the term of a note is longer than a year or longer than an operating cycle, then it is reported as a long-term note, similar to other assets maturing in a greater than one operating cycle. The typical note receivable requires payment of a specified face amount. This is called the principal, similar to any type of loan principal, at a specified maturity date or various dates. In addition, interest is paid at whatever the stated rate of interest is on the face of the note. Interest on notes is calculated as the face amount times the annual amount times or divided by whatever fraction of the annual period you have. So in this example, Stridewell Wholesale Shoe Company manufactures athletic shoes that it sells to retailers. On May 1st, 2016, the company sold shoes to Harmon Sporting Goods. Stridewell agreed to accept a $700,000 6-month 12% note in payment for the shoes. Interest is payable at maturity. Assume that an interest rate of 12% is appropriate for a note of this type. First, on May 1st, 2016, we record the sale by debiting notes receivable and crediting sales revenue for $700,000. Then, we record the collection of notes at the maturity along with the interest. On November 1st, 2016, we credit interest revenue for $42,000, which we calculated by 6 months at a 12% interest rate, and note receivable for its face value of $700,000. So we then debit cash for $742,000, which includes both the principal or face amount and the interest on the note. If the sale in the illustration occurs on August 1st, 2016, and the company's fiscal year is December 31st, then a year-ending adjusting entry accrues interest earned. To recognize the interest earned for the 5 months from August to December, we record an adjusting entry on December 31st by debiting interest receivable and crediting interest revenue for $35,000. On maturity, which is in this case February 1st, 2017, we record the collection of the notes receivable. To do this, we credit interest revenue earned for the 6 months of $7,000, interest receivable of $35,000 that was accrued as of December 31st, and the note receivable for its face amount of $700,000. So cash in this case is again debited for $742,000, which includes both the principal and the interest accrued and earned. Now sometimes a receivable assumes the form of a so-called non-interest-bearing note. This name is a bit of a misnomer, though, because non-interest-bearing notes actually do bear interest, but the interest is deducted, which is also known as discounting, from the face amount to determine the cash proceeds made available to the borrower at the outset of the note. So basically, the note is not changing, but the amount that you actually received as your initial loan is lower to account for whatever the interest rate is that you'll end up paying back. For example, consider a 6-month, $700,000 non-interest-bearing note with a 12% discount rate. In this case, $42,000, which is $700,000 times 12% times 1/2 of a year, interest would be discounted at the outset rather than explicitly stated. We can see that Harmon is really paying $658,000 for the shoes and $42,000 of interest to compensate Stridewell for having a receivable outstanding for 6 entire months. The sales revenue under this arrangement is only $658,000, but the total amount of interest is calculated as the discount rate times the $700,000 face amount. This causes the effective interest rate to be higher than what is stated as the 12% discount rate. This note should be valued at the present value of future cash receipts. The present value of $700,000 to be received in 6 months using an effective interest rate of 6.383% is $658,000. If the sale occurs on August 1st, Stridewell would need to accrue interest at year end. The adjusting entry on December 31st, 2016 will debit discount on note receivable and credit interest revenue for $35,000, which is calculated as $700,000 times 12% times 5/12. Then on February 1st, 2017, Stridewell records the interest revenue as a debit to discount on note receivable and credits interest revenue for $7,000. This is the portion of the interest earned during the month of January. And the face amount of note receivable collected is recorded as a debit to cash and a credit to note receivable for $700,000. In the December 31st, 2016 balance sheet, the note receivable is shown at $693,000. This is the face amount of $700,000 minus the remaining discount of $7,000. We account for long-term notes receivable the same way that we account for short-term notes receivable. The only really big difference is that the time value of money has a much larger effect because the length of time is greater. As an example, this illustration shows the facts in the last illustration to have Stridewell agree on January 2016 to accept a 2-year non-interest-bearing note. It's useful to consider a couple of aspects right now. First, you should notice that the sales revenue in 2016 is not recorded for the full $700,000. Instead, sales revenue is calculated as the present value of $700,000 to be received in 2 years, which ends up being $558,036. The net amount of the note receivable equals its present value, which is what we just said, which is the note receivable of $700,000 less the discount on the note receivable of $141,964. If you recall from Chapter 5, sellers need to recognize the financing component of a contract when the time value of money is significant. That is what Stridewell is doing in this case. It earned sales revenue of $558,036 from selling shoes and interest revenue of $141,964 for financing the transaction. Second, interest revenue each period is calculated based on the net note receivable as of the beginning of that period. As a consequence of this, interest revenue differs between periods because the net note receivable increases over time. In our example, Stridewell's 2016 interest revenue of $66,968 is calculated based on the initial note receivable balance, $558,036, times 12%. We reduce the discount on note receivable for 2016 interest revenue, which increases the net note receivable balance to $625,000. So, Stridewell's 2017 interest revenue of $75,000 is calculated based on that higher net note receivable balance, thus reducing the discount on note receivable to 0 by the end of 2017. At that point, the book value of the note, sometimes called the carrying value or the carrying amount, is the full $700,000, and that is the amount of cash that is going to be collected at that point in time. the effective interest rate stays the same over time, but interest revenue increases as that rate is multiplied by a receivable balance that is increasing over the life of the note. This is an application of the effective interest method by which we calculate interest revenue or interest expense by multiplying the outstanding balance of a long-term receivable or liability by the effective interest rate. If a note with an unrealistic interest rate, even a non-interest-bearing note, is received solely in exchange for cash, the cash paid to the issuer is considered to be the note's present value, even if this means recording interest at a ridiculously low or zero rate. The amount of cash exchanged is the basis for valuing the note. When a non-cash asset is exchanged for a note with a low stated rate, we can argue that its real value is actually less than it's purported to be, but we can't argue that the present value of a sum of cash currently exchanged is less than that actual sum. If the non-interest-bearing note in the previous example had been received solely in exchange for $700,000 cash, the transaction would be recorded as shown on this slide. Similar to accounts receivable, if a company anticipates bad debts on short-term notes receivable, it uses an allowance account to reduce the receivable to net realizable value. The process of recording bad debt expense is the same as with accounts receivable. However, long-term notes present a more significant measurement problem. The longer the duration of the note, the more likely are bad debts. One of the more difficult measurement problems facing banks and other lending institutions is the estimation of bad debts on their long-term notes or loans. As an example, Wells Fargo and Company, which is a pretty prominent bank, reported the information here in the assets section of its 2013 balance sheet. GAAP requires that companies disclose the fair value of their notes receivable in the disclosure notes. They don't have to disclose the fair value of accounts receivable when the book value of the receivables is approximately their fair value. The various approaches used to finance with receivables differ with respect to which rights and risks are actually retained by the transferor, who's the company who is the original holder of the receivable, and which are actually passed on to the transferee, who's the new holder, or the financial institution. Despite the differences, any of these approaches can be described as either a secured borrowing. Under this approach, the transferor or borrower simply acts like it borrowed money from the transferee, with the receivables remaining in the transferor's balance sheet and serving as collaterals for the loan. On the other side of the transaction, the transferee, who's the lender, recognizes a note receivable. If you look at it as a sale of receivables, the transferor, or the seller, de-recognizes or removes the receivables from its balance sheet, acting like it sold them to the transferee or buyer. On the other side of the transaction, the buyer recognizes the receivables as assets in its balance sheet and measures them at their fair value. In secured borrowing arrangements, the lender typically lends an amount of money that is less than the amount of receivables assigned by the borrower. The difference provides some protection for the lender to allow for possible uncollectible accounts. Also, the lender, sometimes called an assignee, usually charges the borrower, sometimes called an assignor, an upfront finance charge in addition to the stated interest of the loan. The receivables might be collected either by the lender or the borrower, depending on the details of the arrangement. You can take a look at this example here. And how the journal entries look. And follow that through to the end of it. Accounts and notes receivable, like any other assets, can be sold at a gain or at a loss, or they could be sold for their actual value. The basic accounting treatment for the sale of receivables is similar to accounting for the sale of any other asset. The seller, or transferor, removes from the accounts the receivables and any allowance for bad debts that's associated with them. Then it recognizes at fair value any assets acquired or liabilities assumed by the seller in the transaction, and then records the difference as a gain or a loss. The two most common types of selling arrangements are factoring and securitization. In a factoring arrangement, the company sells its accounts receivable to a financial institution. The financial institution typically buys receivables for cash, handles the billing and collection of the receivables, and charges a fee for this service. Actually, credit cards like Visa and MasterCard are forms of this type of factoring arrangement. The seller relinquishes all rights to the future cash receipts in exchange for cash from the buyer. Another popular arrangement used to sell receivables is securitization. In a typical accounts receivable securitization, the company creates a special purpose entity, usually some type of trust or subsidiary. The special purpose entity buys a pool of trade receivables, credit card receivables, or loans from the company, and then sells related securities, typically debt such as bonds or commercial paper, that are backed or collateralized by these receivables. Securitizing receivables using an SPE or a special purpose entity can provide significant economic advantages. They allow a company to reach a larger pool of investors. They allow a company to obtain more favorable financing terms because the collateral for the debt are actually owned by the special purpose entity. Therefore, they're not at risk if the company goes bankrupt. Here are a couple of examples that you can take a look at of factoring and securitization. An important distinction to understand is whether a factoring arrangement occurs with or without recourse. If a factoring arrangement is made without recourse, the buyer cannot ask the seller for more money if the receivables prove to be uncollectible. Therefore, the buyer assumes the risk of bad debts. The illustration here is an example of receivables factored without recourse. The company records the transfer by crediting liability financing agreement for $600,000, which is the book value. Cash is debited for $540,000, which is 90% of the $600,000, and receivable from factor is debited for $26,000, which is $50,000 less the $24,000 fee, and the balance amount is recorded as a loss on the sale of receivables. You should pay attention to the fact that the fair value, $50,000, of the last 10% of the receivables to be collected is less than 10% of the total book value of receivables. That's typical because the last receivables to be collected are likely to be reduced by sales returns and allowances, and should therefore generally have a lower fair value. When a company sells accounts receivables with recourse, the seller retains all of the risk of bad debts. In effect, the seller guarantees that the buyer will be paid even if some of the receivables prove to be uncollectible. To compensate the seller for retaining the risk of bad debts, the buyer usually charges a lower factoring fee when receivables are sold with recourse. Even if the receivables were sold with recourse, in this example, Santa Teresa Glass still could account for the transfer as a sale so long as the conditions for sale treatment are met. The only difference is the additional requirement that Santa Teresa record the estimated fair value of its recourse obligation as a liability. The recourse obligation is the estimated amount that Santa Teresa will have to pay Factor Bank as a reimbursement for any uncollectible receivables. Notice that the estimated recourse liability of $5,000 increases the loss on sale by $5,000 from $34,000 in the without recourse case to $39,000 in the with recourse case. If the factor eventually collects all of the receivables, Santa Teresa eliminates the recourse liability and recognizes a gain. We handle transfers of notes receivable in a similar manner as transfers of accounts receivable. A note receivable can be used to obtain immediate cash from a financial institution, either by pledging the note as collateral for a loan or by selling the note. Notes also can be securitized. Sorry, I have trouble with that word. The transfer of a note to a financial institution is referred to as discounting. The financial institution accepts the note and then gives the seller cash that's equal to the maturity value of the note, reduced by a certain amount for a discount. The discount is usually computed by applying whatever the discount rate is to the maturity value and represents the financing fee the financial institution would typically charge for this type of transaction. Because the note has been outstanding for 3 months in this situation, before it's discounted at the bank, Stridewell would first record the interest that is accrued prior to being discounted. The next step is to add interest to the maturity to compute the maturity value. For this, we will add interest of $15,000, 10% of the $200,000 for 9 of the 12 months, to the face value of $200,000. Thus, we get the maturity value of $215,000. The third step is to deduct the discount amount from the maturity value. The discount rate in this case is 12%. 12% of $215,000 for 6 months, from April to September, is thus calculated as $12,900. By deducting this discount amount of $12,900 from the maturity amount of $215,000, we determine the cash proceeds to be $202,100. Similar to accounts receivable, Stridewell potentially could account for the transfer as a sale or a secured borrowing. For example, the illustration here shows the appropriate journal entries if we wanted to account for the transfer as a sale without recourse. Transferors usually prefer to use the sale approach rather than the secured borrowing approach to account for the transfer of a receivable, because the sale approach makes the transferor seem less leveraged, more liquid, and perhaps more profitable than this similar type of arrangement under the secured borrowing approach. The illustration above explains why, describing particular effects on key accounting metrics. The transferor, defined to include the company, its consolidated affiliates, and people acting on behalf of the company, is determined to have surrendered control over the receivables if and only if all of the following conditions are met. The transferred assets have been isolated from the transferor beyond the reach of the transferor and any of its creditors. Each transferee has the right to pledge or exchange the assets it received. The transferor does not maintain effective control over the transferred assets, for example, by structuring the transfer such that the assets are likely to end up returned to the transferor. If all of these conditions are met, the transferor accounts for the transfer as a sale. If any of the conditions are not met, the transferor treats the transaction as a secured borrowing. This illustration summarizes the decision process that is used to determine whether a transfer of a receivable is accounted for as a secured borrowing or as a sale. The company has to provide information about the quality of any transferred assets. For example, for transferred receivables, the company needs to disclose the amount of receivables that are past due and any credit losses occurring during the period. Among the other information the company must disclose are how fair values were estimated when recording the transaction, any cash flows occurring between the transferor and the transferee, and how any continuing involvement in the transferred assets will be accounted for on an ongoing basis. A company's investment in receivables is influenced by several variables, including level of sales, nature of the product or service sold, and credit and collection policies. These variables are, of course, related. For example, a change in credit policies could affect sales. In fact, more liberal credit policies, allowing customers a longer time to pay or offering cash discounts for early payment, often are initiated with the specific objective of increasing sales volume. Management's choice of credit and collection policies often involve trade-offs. For example, offering cash discounts may increase sales volume, accelerate customer payment, and reduce bad debts. However, these benefits are not without some costs. The cash discounts themselves reduce the amount of cash collected from customers who take advantage of the discounts. Extending payment terms also may increase sales volume. However, this creates an increase in the required investment in receivables and, of course, may increase bad debts. The ability to use receivables as a method of financing also offers management some alternatives. Assigning, factoring, and discounting receivables are all alternative methods of financing operations that should be evaluated relative to any other financing methods that exist. Investors, creditors, and financial analysts can gain what they may consider to be important insights by monitoring a company's investment in receivables. To illustrate receivables analysis in more detail, let's take a look at the computation of the 2013 receivables turnover ratio and the average collection period for two companies in the software industry, Symantec Corporation and CA Inc. On average, Symantec collects its receivables 17 days sooner than does Computer Associates, or CA, and 1 day slower than the industry average. A major portion of Symantec's sales of products like Norton antivirus software are made directly to consumers online who pay immediately with credit cards, thus significantly accelerating payment. CA, on the other hand, sells primarily to businesses who typically take longer to pay. This is a look at the differences between US GAAP and IFRS related to these topics that we've discussed. One of the most important tools used in the control of cash is the bank reconciliation. Since all cash receipts are deposited into the bank account and cash disbursements are made by check, the bank account provides a separate record of cash. It's desirable to periodically compare the bank balance with the balance in the company's own records and reconcile any differences. Differences typically arise from one of two items: timing differences or errors. Bank reconciliations include adjustments to the balance per bank for timing differences involving transactions already reflected in the company's accounting records, which have not yet been processed by the bank. These adjustments usually include checks outstanding and deposits outstanding, which are also sometimes called deposits in transit. In addition, the balance per bank would be adjusted for any bank errors discovered. These adjustments produce an adjusted bank balance that represents the corrected cash balance. To demonstrate the bank reconciliation process, take a look at the following illustration. First, we adjust the bank balance to the corrected cash balance. To do this, we add the outstanding debits to the beginning bank balance, $29.65 plus $10.20, or $39.85. Next, we deduct the checks written in May that had not yet been processed by the bank for a total of $5,536. By doing this, we arrive at the corrected cash balance of $33,129. Then we would adjust the book balance to the corrected cash balance. We first add the note collected by the bank for $1,120, which includes $120 of interest. Then we deduct the bank service charges and NSF checks of $80 and $2,187 respectively. We also deduct the error in the amount of $1,000. This totals the corrected cash balance of $33,129. The next step is to prepare adjusting journal entries to reflect each of the adjustments to the balance per books. These represent amounts the company was not previously aware of until the receipt of the bank statement. No adjusting entries are needed for the adjustments to the balance per bank because the company has already recorded these items. However, the bank needs to be notified if any of these turn out to be errors discovered. After these entries are posted, the general ledger cash account should equal the corrected balance of $33,129. Now, most companies keep a small amount of cash on hand to pay for some low-cost items such as postage, office supplies, maybe delivery charges, entertainment expenses, etc. It would be terribly inconvenient, time-consuming, and costly to process a check each time one of these small payments is made. A petty cash fund provides a more efficient way to handle these payments. A petty cash fund is established by writing a check to the custodian of the petty cash. No entries are recorded at the time the actual expenditures are made from the fund. The expenditures are recorded when reimbursement is requested at the end of the month. At that time, a check is written to John Ringo, petty cash custodian, for the total of the fund receipts, $160 in this case. John cashes the check and replenishes the fund to $200. In journal entry form, replenishing the fund would be recorded as noted here. The petty cash fund account is not debited when replenishing the fund. If, however, the size of the fund is increased at the time of the replenishment, the account is debited for that increase. Under current GAAP, an impairment loss on a receivable is recognized if the creditor or lender believes it is probable that it will not receive all of the cash flows, principal and any interest payments, that have been promised by the debtor or borrower. In that case, the creditor remeasures the receivable based on the present value of the currently expected cash flows, discounted at the loan's original effective interest rate. Sometimes a creditor changes the original terms of a debt agreement in response to the debtor's financial difficulties. The creditor makes concessions to the debtor that make it easier for the debtor to pay, with the goal of maximizing the amount of cash that the creditor can collect. In that case, the new arrangement is referred to as a troubled debt restructuring. Because identifying an arrangement as a troubled debt restructuring requires recognizing any impairment loss associated with the arrangement, creditors might be reluctant to conclude that a troubled debt restructuring has occurred. For this illustration, the discounted present value of the cash flows prior to the impairment is the same as the receivables book value, which is $33 million. That amount is determined by adding accrued interest of $3 million, 10% of $30 million, and the principal amount of $30 million. The present value of future interest is $3,471,080, and the present value of estimated principal is $20,661,250. Therefore, the discounted present value of cash flows after the impairment is $24,132,330, which is less than book value. The difference of $8,867,670 represents a loss that should be debited to bad debt expense. Now let's record the journal entry to recognize bad debts expense. We credit the allowance for uncollectible accounts to $5,867,670, accrued interest receivable for $3 million, and debit bad debt expense for the balance amount of $8,867,670. You can take a look at this illustration here that illustrates a troubled debt restructuring. A concern about recognizing impairments of receivables in current GAAP is that it doesn't provide timely information. Impairment recognition is delayed until losses are probable and tends to focus on historical rather than forward-looking information when making that determination. To provide more timely impairment recognition, the FASB has developed the Current Expected Credit Loss, or CECL, model. Under this model, the probable threshold is removed, so the creditor accounts for potential impairments even when the probability of them occurring is quite low. The creditor adjusts its estimate of impairment losses, and therefore the allowance for bad debts, up or down over the life of the receivable as new information becomes available. The CECL model explicitly requires creditors to estimate impairments based on predictions about the future as well as current and past events. So impairments may be recognized even if no past information or current conditions suggest a problem. So finally here, let's take a look at how the CECL model would handle our Briard Properties example. Briard Properties owes First Prudent Bank $30 million under a 10% note with 2 years remaining to maturity. The previous year's interest of $3 million was not paid. Based on its experience with similar loans and its current projections regarding Briard's ability to generate cash in the future, First Prudent estimates that there is a 75% chance it will be paid in full and a 25% chance that it will either A, not receive the $3 million of accrued interest, or B, receive only $2 million of interest in each of the next 2 years and receive only $25 million of principal in the end of 2 years. Because the loss is not probable, current GAAP would not recognize an impairment. In contrast, the CECL model does recognize an impairment, calculated as indicated here. First Prudent would account for the expected loss as bad debts expense, adjusting upward or downward its allowance for bad debts with respect to the Briard loan as necessary to state the net receivable at $30,783,082.